Conference over to Mr. Sahil Bachani, MD and CEO, Max Ventures and Industries Limited, for his opening remarks. Over to you, sir.
Thank you so much, Stanford. Thank you, everybody, for joining the call, and I hope everyone and you are safe and good health. Good morning, ladies and gentlemen. Thank you for joining us on the Max Ventures and Industries Q2FY21 earnings conference call. Along with me today, we have our CFO, Mr. Nitin Kansal, Mr. Rishi Raj, who's Chief Business Development Officer, Mr. Ramneek Jain, CEO of Max Specialty Films, Rohit Rajput, CEO of Max Asset Services, and Mr. Nitin Thakur, Director, Brand and Communications of the Max Group. We also have SGA, our Investor Relations Advisors, on the call. Let me begin by giving you some key highlights for Max Ventures for Q2 FY21. First, we're delighted to share that we have leased 74,000 square feet in Max Towers, leased to a large leading private bank. With this, 75% of Max Towers is now leased. We are seeing a revival in the commercial office space leasing business, and we are confident of fully leasing Max Towers within FY21. Our packaging films business also displayed stellar performance. The margin in the business expanded by 860 basis points to 15%. Revenues up 13% to INR 2,667 million year on year. EBIT up by 168% year on year to INR 401 million. Max Ventures PAT is at a loss of 22 million due to a COVID-led markdown of investment in the hospitality chain Azure Hospitality through our investment through the subsidiary MaxI. The group has strong liquidity with negligible debt in the real estate business and healthy cash flows in the packaging business. Actively prospecting new growth opportunities, including distressed deals in locations such as Gurgaon, partnering commercial real estate funds, and steady progress in the NCLT resolution of our bid for the Delhi One project. Our first commercial real estate asset in South Delhi, Max House, is now ready for leasing. High inquiry volume by marquee companies owing to limited Grade A supply in the micro market. Max House Phase 2 construction to start by Q4 2021. Max Square, our third commercial project in NCR, which is a joint investment between New York Life and Max Estates, also commences construction in Q3 FY21. Our asset services business, Max Asset Services, is now also got off the mark with higher revenues, strong interest, and we have got strong interest in zero Kpix managed offices. MaxI, the investment arm, continues to focus on real tech accelerator program while optimizing our legacy investments. Let me now give you a strategic overview of our businesses, which will be followed by a detailed business updates by our respective business heads. Happy to share that the momentum across our business verticals continues. Accordingly, we witnessed a quarter-on-quarter growth of 11% in EBITDA and 30% in PBT. We've been talking about the sustainability of our performance, and we are happy to therefore report that we are strengthening our position in our verticals and moving in the absolutely right direction. Needless to mention that we have been able to do this through the pandemic. Quarter 2 FY21 witnessed an easing in lockdown as people have accepted the new normal. By end of September, a lot of businesses are back on their way to normalcy much faster than we had expected. In the commercial real estate business, this has translated in actual conversion of lease, and I'm happy to share that we have onboarded a large private bank at Max Towers. With this, the occupancy at Max Towers has reached 75%. I would like to mention here that it's been only 16 months since the launch of this building, with 4 to 5 of those months being COVID lockdown months. Our revenue from real estate business also has more than doubled quarter on quarter, and we will continue to grow strongly as leasing continues. With the economy showing signs of revival, we are very confident that commercial real estate, and within that, the Grade A office market is bound to grow. With recent large acquisitions of commercial real estate assets by foreign investors and significant lease transactions reported, it is very evident that the commercial real estate sector has continued to be an attractive investment opportunity for large global and domestic institutional investors who are pursuing dependable and sustainable annuity revenues. The pandemic, RERA, GST over the past many years has led to concentration of the real estate business with a few developers, and thus well-capitalized developers with proven execution have a fantastic opportunity to grow. We at Maxwell are committed and focused to grow our real estate footprint and emerge as a preferred provider of Grade A office space in the commercial real estate market in the Delhi NCR region. Hence, besides the already announced new projects such as the 700,000 square feet Max Square, Phase 2 of Max House, we are also actively evaluating multiple distressed commercial real estate assets in Delhi NCR with a positive bias for Gurgaon. We are as much open to brownfield opportunities as to greenfield ones. We are hopeful that the resolution process of Delhi 1 will progress in a timely manner, allowing us to add 3 million square feet to the development pipeline. All this is targeted towards making us one of the top 3 commercial real estate developers in North India without stress on our balance sheet. Moving to our packaging business. The packaging business continued to post strong growth. Max Specialty Films revenue and EBIT for Q2 FY21 grew by 13.3% and 168% respectively year-on-year on the back of stable realizations, benign raw material prices, and strong cost optimizations. With increasing preference for packaged foods among consumers, complemented by a focus on more profitable value-added specialty films, we are confident to sustain the profitability of this business going ahead as well. Our liquidity position remains comfortable. We've been able to finance our existing and announced office developments through our own funds or minimal leverage and financial partnerships. We will continue to adopt this approach. Frugal Kpix and return optimization will be a key tenet for our future real estate developments as well. We have a minor debt in our real estate business currently and healthy and steady cash flows in the specialty film subsidiary, which are more than adequate to service the debt in that business. I would also like to mention here that we have reduced the debt significantly in our packaging business over the past 6 months. Before I hand over to my colleague Rishi for the real estate update, it is important for me to share that our Q2 FY21 PAT has been impacted by a mark-to-market loss of an investment in our subsidiary Maxi pertaining to Azure Hospitality. We're all aware that the restaurant industry was one of the worst affected by the pandemic. To ensure its competitiveness and growth, a new round of fundraise was undertaken at a lower valuation than the previous one. This led to a one-off impact for us to mark-to-market this loss. We expect the business to do well as the economy is picking up pace, and we believe that there will be growing demand for this business as well. I would now like to hand over to my colleague Rishi to take us through the real estate business. Thank you.
Thank you, Sahil. Let me take you through real estate business highlights. As rightly pointed out by Sahil in his opening remarks, commercial real estate sector leasing is showing clear signs of recovery and stabilization and will only grow from here. It is evident to an extent by recent large transactions involving acquisitions of domestic commercial real estate properties by foreign institutional investors, as well as several large leasing transactions pan-India. These significant transactions have materialized because investors and large corporates have immense confidence on economic success and potential of India in times to come. It is also corroborated by the increased query volume we are witnessing for our assets. It is getting evident now that work from home will have no material impact on the commercial real estate. In countries such as China, South Korea, Germany, France, where COVID is relatively controlled, a substantial proportion of employees are back in office by an estimate 84% in France, 74% in Germany, and close to 100% in China. There are several reasons why the expected impact of work from home has diluted over a period of time, For example, people have adapted to live with COVID-19 and have started visiting offices by taking utmost precaution. Cost savings are not material enough, unlike what was expected. Knight Frank study on tech companies in India pegs net cost saving at less than 1% for IT companies for a 50% work from home scenario. The feedback from employees about burnout, lack of human interaction, lack of infrastructure and space constraints is also driving this trend. One of the surveys that Knight Frank conducted, close to 90% of employees miss their office environment. Other important aspects that corporates have to evaluate, such as data security issues, organization culture, impact on collaboration, mentoring, and innovation. And the narrative from top global and domestic IT companies with respect to work from home and its sustainability longer term has diluted, which is also reflected in no material reduction in real estate portfolio by top corporate occupiers in India. Now let me give you project-wise highlights starting from Max Towers. After a brief slowdown in leasing, we are getting our stride back. As Sahil updated, we are delighted that we signed a lease with a large private bank at Max Towers. With this, we are adding another large tenant at Max Towers, and the lease has been signed at a headline rental not only higher than weighted average rental of 100 square feet that we have reported earlier, but also higher than any other deal we have done pre-COVID. This is in fact contrary to market expectation that rental rates will reduce, and in line with our strategy, we continue to ladder up the weighted average rental as we are now inching towards the last leg of leasing at Max Towers. With this lease, the total leased area at Max Towers now stands at 390,000 square feet. Total leased area attributable to Max Estates stands at 209,000 square feet. On an occupancy basis, this implies 75% occupancy. Our tenants at Max Towers are from various different industries, helping us to diversify the risk associated with leasing to a specific industry. In spite of disruption caused due to COVID-19, our rental collections in Max Towers are healthy and more than 90%, and we did not have any of our office tenants vacate our premises. We also launched our second Grade A plus commercial project, Max House Phase 1, during Q2, after completing the project within schedule and budget despite COVID-led disruption. We are encouraged with the inquiries that we are receiving from prestigious Indian and multinational companies for this project, and thus are confident to lease it fully by Q1 of fiscal year 2022. Work on Phase 2 of the project is targeted to start construction in Q4 of fiscal year 21. We expect to attract a similar reputed tenant profile for both these projects like we have done for Max Towers. Work on our third Grade A plus commercial project, Max Square, has also commenced, in which New York Life is our investment partner. All statutory approvals, including building plan, environmental clearances, etc., have been received in a record time of 5 months despite COVID-led lockdown. The project is expected to be delivered by Q4 of fiscal year 2023. The project, as we had updated earlier, will be built at a cost of approximately 400 crores with equity infusion of 175 crores and debt funding of 225 crores. We are delighted to share that financial closure of the project has been 100% achieved. The distressed project, Delhi 1, which we updated you about in the last call, which we had bid for, is still under NCLT hearing. We have already received approval from the Committee of Creditors and we have been declared as a successful resolution applicant. Our plan is with NCLT for final approval, which got delayed due to lockdown. The good news is, post-lockdown, the hearing has restarted in the month of October, and we hope to get the final clearance by end of fiscal year 2021. We strongly believe the ongoing consolidation in real estate will continue to benefit the developers who are well capitalized and have a proven execution history. Developers who have expertise and ability to upfront fund the Kpix for the project will grab a large share of the market. Max has a history of good partnerships with large institutional investors, and we will leverage this network for co-developing the future project like we did for Max Square along with New York Life. Max being a trusted brand with focus on grade A plus commercial office segment, strong balance sheet, proven execution now, and with access to institutional equity capital, is well placed to make its mark in commercial real estate market in Delhi NCR region, our focus in the near term, and become one of the top commercial real estate developers. As Sahil mentioned, we are committed to scale rapidly by on-streaming Delhi One and by acquiring other brownfield or greenfield assets, preferably in Gurgaon. This is something I'm personally investing a lot of time and attention to. However, we will be careful to ensure good margins and return, relatively clean asset, and attractive location as prudential investors into real estate projects. Given our governance track record and our recently demonstrated execution capabilities, we have adequate interest from global institutional investors to be financial partners in future opportunities, and with that partnership, march forward on our growth journey following our stated capital light strategy. With that, let me hand over to Rohit to give an update on Max Asset Services and Max Investments.
Thank you, Rishi. Now let me give a brief highlight about Max Asset Services and Max Investments. Max Asset Services has played a very crucial role in implementing new age technology tools such as our mobile app, video analytics, advanced air filtration techniques, visitor management, etc. in offices, which is essential to provide safe and healthy working environment. For example, at our new development Max House, we have 6 levels of air filtration, which is unparalleled in any multi-tenanted building in India. In addition, more and more offices are availing our facility services, and we continue to expand the gamut of services offered by us. As a result, our revenue from the business almost doubled sequentially to 45 million in Q2FY21 as compared to 24 million in Q1FY21. We expect the business to be profitable very soon as the business scales up. At Max Investments, there have been developments at both our existing investment in FSM e-commerce, which is Nykaa, a beauty, e-commerce and retail venture, and Azure Hospitality, a leading restaurant chain. We had invested 175 million for 2% equity in Nykaa in 2016. We have sold its entire balance stake of 62,269 shares, 0.41% in Nykaa. With this exit, our total exit value is estimated at rupees 821 million on an investment of rupees 175 million. It's an exit multiple of 4.7x. With respect to Azure Hospitality, we'd invested rupees 714 million for a 17.9% equity. As we know, the COVID-19 pandemic had impacted businesses in every sector. However, the restaurant industry suffered one of the worst impacts of the pandemic. Most of the restaurants were allowed to start only towards the end of Q2 and are still not permitted to operate at full capacity in certain cities. Hence, to ensure the business sustains and grows, a new round of fundraise is undertaken, albeit at a lower valuation than previous one. We did not participate in the new round, and hence our stake is now valued at rupees 445 million. Hence, the mark-to-market loss of rupees 270 million is charged to P&L as an exceptional item. We expect the business to do well as the economy picks up space and restaurants and dining out grows. Now let me hand over to Mr. Ramneek Jain.
Thanks, Rohit, and good morning, everybody. This is Ramneek Jain. Happy to take you through the MSFL report. MSFL continues to post robust operational performance in Q2FY21. There is a strong preference for consumption of packaged food versus open food due to the growing awareness of health and hygiene. We have delivered many advanced packaging solutions working with the leading FMCG companies. This has been well accepted by the clients. Our research team continues to innovate on packaging needs, keeping in mind the clients' need, making us the preferred partner for specialized firms. Value-added specialty firms contribute 40 to 50% of our total volumes in Q2 FY21. MSFL EBIT increased by 168% to rupees 401 million in Q2 as compared to Q1, and EBIT margins expanded by 860 BPS year over year to 15% in Q2. Work on a new metallizer line has also been progressing well, and we expect the same to be commissioned in the Q4 of FY21. While this line will not increase the overall capacity because the base film remains the same, but it will enhance MSFL's ability to improve the value-added specialty component and its product strategy even further. With favorable domestic and export demand, stabilized supply, and improved realization, we expect healthy profitability to continue going ahead as well. With this, I'll hand it over to Mr. Nitin Kansal. Thank you.
Thanks, Amit. Good afternoon, everyone. Let me give you the financial highlights for the Q2 financial year 2021. The consolidated revenues for Q2 FY21 stood at rupees 2,890 million rupees as compared to 4,346 million rupees in Q2 FY20. However, the financials of Q2 FY21 cannot be compared with the financials of Q2 FY20, as during the Q2 FY20 we had recorded a one-off sale transaction of rupees 1,892 million rupees in Max Tower. Hence, excluding these one-off transactions, we can look at it this way. Revenue has in fact increased by 18% year-on-year from rupees 2,453 million rupees in Q2 FY20 to rupees 2,819 million rupees in Q2 FY21. EBITDA for Q2 FY21 stood at rupees 523 million rupees as compared to an adjusted EBITDA of rupees 244 million in Q2 FY20. Up by 115% year-on-year. Profit before exceptional items and tax stood at rupees 307 million rupees in Q2 FY21. Adjusting for the sale of Max Tower, there was a loss at the PBT level. As mentioned before, we have recorded an exceptional loss of rupees 271 million on account of fair value assessment in one of the Max Tower investee companies, Azure Hospitality. As a result of that, we recorded a loss of rupees 22 million in Q2 FY21. However, this is a non-cash exceptional item and does not impact our core business in any way. Going forward, also let me give you now a brief on the segmental financial highlights. Our real estate business, which is housed under a wholly owned subsidiary Max Estate Limited, revenues stood at rupees 111 million in Q2 FY21. Of that, lease rental income from Max Towers stood at a consistent level of rupees 41 million in Q2 FY21 as compared to 44 million in the previous quarter. We have achieved a weighted average rental of rupees 100 per square feet at Max Towers. Revenue from Max Estate Services has almost doubled sequentially from 24 million in Q1 FY21 to 45 million in Q2 FY21. We expect to continue to grow this business as more management contracts get added to the portfolio. Our packaging films vertical revenue, MSFL revenue stood at rupees 2,667 million rupees in Q2 FY21, up by 13.3% year-on-year and 6.2% sequentially quarter-on-quarter. EBIT for the packaging business stood at rupees 401 million rupees in Q2 FY1, up by 168% year-on-year and very similar to the numbers in the previous quarter. EBIT margins continue to be stronger at 15% in Q2 FY21, expansion of 860 bps year-on-year. Speaking about our liquidity position, gross debt in our real estate business, Max Estate, stood at rupees 1,123 million rupees as on September 20. Cash and liquid investments stood at 1,049 million rupees. Hence, on a net basis, it amounts to a minuscule debt of 74 million on the real estate business. We do plan to take a conservative debt for the Max Square project, but will be extremely careful not to over-leverage the project. The gross external debt in the packaging films stood at 3,741 million rupees as on September 30. Excluding cash and liquid investments, the net external debt for the business stood at 3,674 million. We have reduced our net debt in packaging business by rupees 632 million as compared to March 20, and will continue to reduce part by part with the cash flows of the business. Now I'll request to hand it back to Stanford. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star then 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star then 1. First question is from the line of Nitin Shakdher from Green Capital Single Family Office. Please go ahead.
Hi, good afternoon to the team, and congratulations on the steady set of results for the packaging business. However, my question pertains to the real estate business. So last quarter, we see a sales revenue of about 198 crores, which I'm assuming is part of the asset sale of Max Towers. But this year, that revenue has gone to 11 crores for this quarter. Without the asset sale, can you give me a comparison figure on the real estate figure for last quarter versus this quarter?
So to answer you, Mr. Nitin, on the subject, we had in the last quarter we had recorded a revenue of 198 crores on account of sale at Max Towers. In the current quarter, our income is composed of two components. We have got a rental income of 41 million rupees, and in addition, we have also liquidated our inventory at Q2 Road, resulting in revenue of 70 million rupees. A total revenue of 11 crores getting reported on the real estate business, and plus we've got other revenue of 3 crores, making a total revenue of 14 crores being generated from the Max estates.
Okay, so that's a flat performance in that sense. It's pretty much comparable in the context of what happened last quarter if I take out the asset sale.
Yes.
Okay. And the next question pertains to the stake in Azure Hospitality. Any indication as to how you plan to reduce that stake? I wouldn't say increase, because obviously the situation will take much more longer to recover than originally envisaged. Versus increasing stake or selling out in Nykaa rather than in Azure Hospitality as a venture stake. What's the management feel on this investment?
Sure, thank you. I'll take that. This is Sahil here. Thanks, Nitin. Hi. So, absolutely. I think there are what we see is that moving forward in FY22, there will be a lot of opportunities around consolidation in the F&B space, and we're very confident that we will be able to monetize our investment at the right time and at the right value with the opportunities that come up. We are also co-invested with Goldman Sachs in this particular investment, so in that sense, the interests are completely aligned.
Okay, great. That's all from my end, and thank you, and wish you all the best for Q3 and Q4.
Thank you very much.
Thank you. The next question is from the line of Nitin Shetty, from an individual investor. Please go ahead.
Hello. Hi. This is for Vijay. Hello?
Yeah, go ahead.
Hello. Yeah. I was wondering how come Rajpur is not getting sold, and it's why is the inventory still there? Because it's been ready for a bit, right?
Yeah. So your question is about 222 Rajpur and
Rajpur. Yeah, I see that there's a lot of inventory left, and it's been ready for a while, and the product seems excellent. So I'm wondering how come you're not able to sell it.
Yes. Let me. Yeah. Thank you for asking that question. Let me answer that. In 222 Rajpur, in total we have 22 luxury villas ranging from INR 4 to 8 crore. We have in total sold 16 and 6 is remaining. The good news is, of course, all of us are aware of the impact on luxury residential villa or luxury residential real estate market pan-India. But the good news in our case now is, out of those 16, 2 which have been sold in the quarter 2, and I'm really happy to share that we have a very strong pipeline and we are very confident of selling another 2 or 3 by the time we end this financial year. So yes, it was slow since the completion because of the external environment, but the interest is getting revived and picking up, and we are very confident of further monetizing it.
My other question is on the co-working space. Now, we've seen that everybody panicked on the office space and now it's coming back to normal. And for me, co-working was basically a disruption in real estate after a very long time. So why is it that you are not bullish on co-working now when everything is coming back to normal?
Yeah, so our strategy at this point in time is to focus on grade A plus commercial office space. In general, we are bullish, and this is our stated position even in the last quarter. We are, from a mid to long-term standpoint, we are bullish and very positive on overall commercial office space as a business. And then within that, I'm sure co-working will also have its own share. They will need to adapt and adjust to the post-COVID and post-pandemic environment. But in terms of overall office space, we are very bullish for several reasons. I think number one, as I mentioned in my narrative, the expected or anticipated impact of work from home is getting diluted. That is also now getting reflected in the narratives from global and domestic IT companies, so much so that they have actually renewed their lease transactions and have signed new leases pan-India. We continue to be, as we speak to, as a part of our initiative, connect with top 50. In their estimate, work from home will have some share in the mix, but at best 15 to 20%, which will get offset through de-densification norm, wherein space allocated per person from 60 is inching upwards. It may not double, but definitely it will significantly increase from the current level. I think second reason that we have also stated earlier is the trend towards outsourcing and offshoring will continue to accelerate, not just by US companies, but also European companies, which currently accounts for only 10 to 12% share in the overall mix. I think third, demand and supply situation will continue to remain tight, particularly in NCR. If you look at quarter 3 results, and if you look at, while it has significantly improved compared to quarter 2, the impact on supply in NCR is much larger than the impact on absorption. And for us as a grade A plus commercial office player built to lease, we see a huge opportunity to garner market share in NCR. And finally, we are very confident, and we are seeing that in our discussions with potential tenants and some of the leasing transactions we have done actually during COVID, that there is a flight to quality, and that trend will continue. So overall, we are very bullish and will continue to focus on commercial office space as a part of our proposition to tenants. We are of course proposing them to do zero Kpix plan, where with help of our Max Asset Services led by Rohit, we are also providing the service of design, build, and managing their office end to end, which is being significantly appreciated by the tenants we are interacting with.
seconds. Share one last question. I'm calling you from Hyderabad, and Hyderabad also growing quite fast. And all our grade A office spaces are going between 60 and 75 rupees. Okay, I was just wondering, what is the biggest advantage that NCR offers over the places like Hyderabad?
Yeah, the choice of cities is actually an outcome and a function of the overall business strategy of that particular corporate occupier. When it comes to NCR, if you look at $1 micro market, be it Golf Course Extension Road in Gurgaon, Noida, where we are present, on Noida Expressway, where we have launched Max Square. I think these $1 micro market for developer-owned and developer-managed assets is attracting significant interest from grade A marquee clients. So as far as choice between the cities are concerned, of course, that is a function of many factors, including companies' overall business strategy. But when it comes to people looking for $1 and something around $1, people are really gravitating towards these micro markets, and for the assets which are developed by credible and reputed developers, and they're moving away from strata sold, which has been one of the dominant way people have been delivering commercial office space in NCR, which for good is now changing, and that's where we would like to play, and we would like to.
What do you mean by strata sold, sir? What do you mean by strata sold?
What happens is a lot of developers, what they do is, instead of building and owning and managing on their own, they sell spaces. Instead of leasing it out, they sell it to individual investors. So it's like a fragmented ownership in the building, and then that gets leased out, which leads to dilution in the quality of managing office to the desired standard, which post-COVID is becoming one of the prime concerns of existing occupiers, and they're looking to move out from those assets and move to developer-managed and owned assets for health and safety reasons.
Okay. Great, all right. Yeah. If there's no one in the queue, I'd like to ask a question to Ravi.
I think there are quite a few in the queue, so
I'll get back.
Thank you.
I'll get back. Yeah.
Thank you. The next question is from the line of Samarth Singh from TPF Capital. Please go ahead.
Hi, good morning to the team. Just a few, balance sheet questions. For Max Okhla, please can you tell me, out of the 118 crores that we were supposed to pay for, the 85% stake in Pharmax, how much has been paid so far?
Second, can you take that?
Good one. Yeah, I'll mention that. So we have paid close to 90 crores against that, and the remaining amount is payable against that. We pay around 38 crores is pending against that.
Okay, great. And I think the plan for Max Okhla was, after getting phase one up and ready, we'd sort of lease it out and use an LRD to finance phase two. And I think now the plan is to go ahead and start phase two in Q4. Does that mean that we have, that sort of visibility into leasing out Okhla, or is it that, maybe we'll use the cash flow from the films business to finance phase two?
So, listen, I can give a. Okay, go ahead.
Sure. Please get on the show.
No, I'll just quickly give a quick update on the leasing, and then you can please respond to the funding question. So on leasing, we got completion certificate for Okhla in the month of July, end July, early August. And as I mentioned in my earlier remark, there is a very strong inquiry pipeline and interest now for Okhla asset. This asset is one of the few grade A plus supply available in this part of the micro market. And we are very confident, given the pipeline and the discussion which is ongoing as we speak, we are very confident of leasing a substantial proportion by the end of the financial year and fully leasing it out by first quarter of next financial year. That's what we are anticipating and planning on the leasing front.
Samarth, to mention, we are still on the same plan to do construction of our phase 2 by the LRD of phase 1. We expect the leasing of Okhla, which you mentioned, to be done by the quarter 1 of the next financial year. There might be a certain working capital required in the interim, which we would put from our sources, but the long-term plan remains to do phase 2 through LRD of phase 1.
Okay. Okay, great. Thanks. And on Max Square, what has been our total investment so far?
So on Max Square, both the investors, we own around 51% and 49% is owned by New York Life. Both the partners have in their shareholding within 140 crores. An amount of 70 crores each has been put by both the partners.
Okay. And could you just explain to me for Max Square, since we're only 51%, when we take the debt on, the debt will be taken on at the Max Estates level or on the Max Square level, and how will that debt reflect on a balance sheet?
So that this entity would be a subsidiary on the balance sheet of Max Estates. So although the debt will be taken in the books of the subsidiary itself, but it will be reflected as debt on the consolidated balance sheet of Max Estate.
Okay, so 100% of the debt will be reflected on the balance sheet. Okay. Okay, and then just two more questions. One is on specialty films. I think we had a 30 crore Kpix. Was that for the Metallizer Line 5 that we are talking about?
Yes, that is for Metallizer Line.
Has that been spent?
So that amount, the order has been placed for the same, and we expect the line to be up and running by the last quarter of the current financial. The delivery of the machine has got slightly delayed because of the pandemic. Earlier, we were expecting it to get the plant to be up and running in the third quarter of the current financial.
So can we expect the debt to go up by another 30 crores or so once we spend that money for the line?
No, both the equity partners have put their respective shares. Both the Japanese partner Japan Printing and Max Ventures have bought that money as equity in the business.
Okay, so that's already been brought in.
Absolutely, yeah.
Okay, and we are running that. I mean, I think we're doing about 50 crores EBITDA a quarter, which I think, at a debt of, I think 375 odd crores. That's like a 1.8 times debt to EBITDA multiple. I'm assuming we are pretty comfortable with that multiple. So what is the plan for the cash flows going forward from this business from the next 2 quarters?
So we are in the gradual process of reducing the debt. If you see our numbers from March 20, we have brought down the debt from 434 crores to 374 crores, a reduction of 60 crores. Our plan is from this cash flow, we will embark on a specialty journey. We might order some other machinery, which are in the range of 25-30 crores, which will give more impetus to our value journey. And the remaining capital, we intend to reduce the debt.
Okay, great. And thank you for that. Last question is, could you just give me the breakup of the debt between long-term, short-term, and working capital?
Of Max Specialty Films?
Of the total business.
Yeah, sure. So on the total business, we have got a long-term debt of around 347 crores, a short-term debt of 105 crores, and we have got liquid cash of around 13 crores, resulting in a gross debt of 438 crores across both the businesses, the packaging film business and the real estate business.
Okay. And have we seen any reduction in interest rates since end of the year, since March 2020?
Yeah, so all our borrowing and the packaging film business and the Max Ventures real estate business are linked to the 1-year MCLR of the bank, and gradually the rates are getting reduced, which are also getting reflected in our borrowing cost. The borrowing cost of the packaging film business has got significantly reduced from double digit to now in an average rate of 9.25.
Great. That's all from my side. Thank you so much.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity. My questions are specifically for the packaging films division. My first question is pretty basic. Just wanted to have a sense on why the margins are so volatile in this business. To my understanding, there should be a cost pass-through business. That's the first question, please.
So hi, this is Ramik. Ritesh, thanks for the question. If I just understand, your question is why the margins are increasing? Sorry, is that the question?
It's quite, yeah, the margins, one is it's increasing, it's good, but it's quite volatile as well. So if I look at it on a EBIT per kg business, basically FY20 it was 12 rupees, Q1 it was 25 rupees, Q2 I don't have the volume number, so I don't have a sense on EBIT per kg for the quarter. So wanted to have a sense on what are the right things which we are doing which is leading to pop in EBIT per kg, and why is it a bit volatile?
So, Ritesh, I'll answer it in two-part question. Two parts. One is, generally, as we have shared, the business is in a positive cycle with regards to the whole industry also, and it's the specific strategy that we have adopted over the past year and a half. And that's how we have been investing and structuring ourselves and working at all fronts with the suppliers, the whole, R&D side, customers, product strategy, etc. And demand cycle has also been healthy because the supply side has been pretty stable across the industry, and the demand because of the pandemic has increased as enough has been talked about the preference for hygiene products, and also I would say in addition to that our own strategy of the specialty and the preferred suppliers to FMCG companies. In terms of the volatility, Ritesh, while I'll not be able to share numbers as per the kg form, but I think I would hold that our performance financials have been quite stable. If you see Q1 to Q2, we have been very stable, and actually the improvement in financials has been happening over the past few quarters in a steady manner. So I think we are not as volatile as probably others may be. So that is what I would sum it.
Sorry to probe a bit over here, but if one looks at FY20, EBIT per kg was around 12 rupees, and that has moved up to 25 rupees. So just wanted to have a sense of, is it something that we have done right on the raw material integration side or on the value addition side?
Yeah, I'll come in there, Ritesh. Sahil here. Actually, you see, this is a cyclical industry to some extent, and the additions in capacity are not linear but more quantum in nature. So what happens is that in FY19 and FY18, FY19, there was a bunching of capacity that came together. So while the growth in demand is more linear, the growth in capacity was quantum at that time. There were 7 lines that got added, whereas our belief is that the Indian market can absorb about 1.5 lines per year. And that led to a temporary suppression of prices, which has now got normalized and corrected.
That's helpful. You made a remark that our impetus is on a value-added journey. Can you explain this from a capital allocation point of view? I understand you're setting up a 30 crore metalizer line, which will get commissioned by end of the fiscal. But if one had to look at this particular capital allocation decision, how would you quantify it when it comes to margins and from a ROC point of view, specifically taking into context the demand-supply angle which is there in the country?
Okay, so I think the first fact that the investment for this metalizer is brought in by the partners, that is just a reflection of the confidence we have going into the partners have going into the company. The value strategy, of course, as explained, is to work on specialty, so keeping the asset-light approach and continuously working to reduce our debt. We feel that in our specialty journey, the focus is on being able to add specific need solutions to the customers. So metalizer is one area, is one of the products which helps us to give the higher barrier properties which help the product for its shelf life purpose. and also the ability to replace polyester from the recyclability point of view. So this product line is much more profitable, as you can imagine. Either you sell a plain film or you sell a film along with some value added, some kind of a coating or lamination to it. And so the metallizer will help us. So to the extent of the quantity it takes in, before we were just selling that as a plain film. Now we'll say that plain film treated in a certain manner. So obviously it enhances our earning on that segment of the volume, and further increase our specialty portion of the total quantity we sell. So from an investment point of view, it's pure equity brought in by the partners. The return is definitely within the acceptable norms of the company. And as we already mentioned, our expected investments into the future of this company will remain to be in similar areas of value-added equipment that enhances our ability to offer more niche needs to the end customers.
That's helpful. Just one last question. Globally, there has been a lot of focus on environmentally sustainable packaging. So just wanted to get a sense, the product offerings that we have, is it recyclable? How should one look at it from an environmental standpoint? Thank you.
So, Ritesh, thank you for asking that question. Glad you brought up the topic. So that has been a key part of our specialty journey, where the leading brands in India, you name it and we have it, they have been constantly working and increasing the offtake from us for the recyclable products. So first of all, we only make BOPP, we are not into polyester. And globally, the trend is to shift from polyester to BOPP or to a single plastic family business. So this is where BOPP has an edge. We have shifted a lot of business from FMCG companies from polyester to BOPP, and this trend is only increasing pace. Added to that, the demand for higher barrier and specifically for recyclability, there is a lot of work going on with regards to biodegradable, as well as in terms of the current need, which is the antimicrobial and antiviral. So while the viral and the microbial is from the hygiene point of view, talking about the environment, very happy to share that we have some very, very exciting projects already ongoing, ramped up, and now they are expanding to other SKUs of the brands based on the confidence they've already seen on the few initial pilot runs that they did, where they covered the entire SKU, and now they're spreading it to other SKUs. So we remain very excited about what we have on our plate getting into the next year as the volumes ramp up on some of the SKUs.
That's interesting. Thanks for the answers. I'll follow up with more questions through email. Thank you.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. The next question is from the line of Shubham Agarwal from Equitas Investments. Please go ahead.
Good morning, everyone, and thank you for the opportunity. So my first question is regarding the specialty business. So we did a 13% growth in revenue, but what was our volume growth for the quarter, and what is the current capacity utilization that we are working on?
Hi, Shubham. Thank you for the question. So, from the capacity utilization point of view, we are close to about 90-95%. And let me again just say, which I mentioned in some previous calls, but again, capacity utilization can go up or down a few percentage points based on the thickness of the films that we manufacture. So at any given point of time, we can manufacture a thick film at the same speed versus a thin film. So in terms of the quantity, the tonnage, the thicker films will command a higher volume in terms, the higher tonnage, and thereby capacity measured in tonnage. In terms of, again, the value-led strategy, so we are remaining at the fixed quantity in terms of what we're producing, but definitely our bottom line is improving, as we have seen in our financials, because of our specialty journey and the strong market.
Okay. And sir, given that our margin now has remained constant over the last quarter, more or less, and but I wanted to understand where do we see the spread getting stabilized going ahead?
Well, I hope our margins will only improve further, Shubham, as our specialty journey continues, and that is the whole simple and straightforward approach we've been working on. That the more specialty with the same volume should be in higher margins. So we definitely hope that we are going to improve our margins further, and I remain very confident that we are going strong on the journey.
Okay. So to understand this a bit better, so when we say specialty film, we are doing around 40 to 50% of the total film business. So what is the difference of spread between a specialty film and a normal film?
So, good question. And see, there is not a standard definition of the industry. So each company identifies what they call specialty versus commodity, and most of the time it is based on the earnings that, above this and below that. So generally, the spread, I would say that, it's if you have a commodity at X, the specialty could be about 1.7X. Okay, it could be 2X. And you have to average it out. There are certain ones which go much higher. There are certain ones which are slightly above. So that is what it is. And what happens is that sometimes you will see the commodity going up because of the industry pricing fluctuation. But the specialty remains pretty strong and stable. And that's the advantage of bringing more stability to the financials as the percentage of specialty goes up, because there obviously our negotiation capability or the value proposition is much stronger. So at the time when the commodity is also strong because of the market, the gap may narrow to the specialty. But at the time when the pricing falls in the market, specialty stays in the gap. So the gap can fluctuate a little bit, but the whole idea is that it brings us higher revenue, higher earnings, and more stability.
Okay. So then my last question is regarding the overall industry demand and supply situation, and also our plan going ahead, given we are currently working at 95% capacity. So how do you see if going ahead, if we are planning to add another BOPP line, and the industry overall in the next 1 or 2 years, how many lines are expected to come on stream?
So good question again. I think to our understanding as of right now, there are about 3 more lines which will get commissioned in the next January to December calendar year. Actually, I would say up till March 22. And Sahil had already shared, the industry had a bunching couple of years back, and since then everybody realized that wasn't a very, that kind of destabilized everybody. So past 2 years, the last line which got commissioned was our line in March 18. And then the next line should come up by March 21 or something. So I think the industry is fairly okay in terms. Having said that, coming to our particular planning, has also said that, we are working to reduce our debt and bringing meeting the expectation of the shareholders about the returns and ROCE and ROE. We need to make sure that we get a good return for our investment. And so as of this time, we continue to focus on our value strategy, wherein how to generate more earnings from the existing quantity. Having said that, at some point we will go in for further capacity enhancement, and it's a progressive state, so there is always a possibility that a new line may bring in about 2,000 tons or 2,500 tons a month more at the same time, or 3,000 tons. We could always get into a contract of buying 1,000, 1,500 tons if we need to, as we see the volume maturing and the demand increasing for our specialty products. So it's a balancing act, but definitely keeping a very close eye on ensuring that we reduce our debt and increase the realization of the return on that investment.
Fair enough, sir. Thank you for the opportunity again. Thank you.
Thank you. The next question is from the line of Jaikishan Parmar from Angel Broking. Please go ahead.
Yeah, hi. Thanks for the opportunity. I have just a couple of questions. First, it's just a suggestion that overall, presentation gives a good understanding of a business update. But I know it's a small request to if you put one slide on how much Max Estate owned leasable area in each project. Because, going forward, we'll have JV and everything. So if we have one slide on Max Estate owned leasable area, that would be great, helpful for us. That's one. The second question is how much profit we have Max recognized in Nykaa or earned in Nykaa exit. Third is I just want to understand Max asset service realization, on how much square foot facility service we have today on realization per square foot for Max asset service. We earn 4.5 crore on servicing on how much square foot. And last question is that in last con call, we have mentioned that over a period of 5 years, we'll develop 5 million leasable area. So just ballpark rough capital structure detail if you can give, that will be great. Thanks.
Yeah. So,
Thanks.
Nitin, go ahead.
So thanks, Jay, in the terms of the area, just to give you a sense of how the numbers of the leasing of Max was just turning out. We have got a total of around 6,15,000 square feet of space at Max Tower, out of which around 2,63,000 square feet of space has been sold to institutional investors. Of the remaining 3,52,000 square feet available with Max Estate, 2,92,000 square feet is available for leasing. Out of the 2,92,000 square feet, the area which has been leased attributable to Max Estates is around 2,09,000 square feet.
Okay.
And what we will do is going forward in the next time around the presentation, we will try to capture that also.
Thanks.
Yeah.
Hi, Nitin, can I come in on Nykaa?
Yes, please.
Yes. Jaikishan, your second question was related to Nykaa. In Nykaa, as you mentioned, we invested 175 million rupees in 2016, and we exit value estimated at 821 million in 2020. So if you do the math, you'll get an idea of the profit we made in the investment. The second question that you have is on MAS realization.
Yes.
What's the area under facility management? The current area under facility management with the recently added Max House is the entire leasable area of Max Towers plus the leasable area at Max House. In terms of the income that's coming to Max assets, it's coming in from 2-3 lines. One is what we call as facility management for the entire building, where we get a cost plus margin. The second is from various service packages that they're offering as a value-added services to our tenant for managing the office within their premises, within their leasable area. And the third is, as Rishi mentioned, we've been pioneering a few zero Kpix solutions where we've been generating some fee-based income on design and build services that we're doing for our clients. Hope that addresses your question.
Yeah, it is fine, sir.
Yeah. So on the last question with respect to growth pipeline, we continue to be on track for 4 to 5 million square feet that we talked about when where we said we have some line of sight. Of that, clearly Delhi one is roughly 3 million square feet. And as we speak, we are in discussion and evaluating a few projects in Gurgaon, particularly on Golf Course Extension Road, where we will see a significant upgraded infrastructure also expected, as well as on some parts of NH8 here in Gurgaon, part of the NH8. I think we are confident of bringing some of those opportunities back to you in subsequent earnings call once we have curated it a bit further. In terms of funding, again, as a part of our stated strategy, we will be growing moving forward in a more asset-light way through partnerships with institutional investors and funds, wherein we will have two roles. One, we will be an investor into that project. The proportion will actually vary from case to case. In Max Square, it was 51%. In some cases, it could be 25-30%. Again, it depends on project-specific partnerships, but it will be asset light. And second, we will be execution partners in those projects, wherein we will take the responsibility of executing the project end to end, from construction, development, leasing and asset management, for a fee which again will be defined on a project-specific basis. So that's what our strategy will be. And with respect to exact capital structure, please allow us to share that as we bring you specific opportunity in future, as we have already done in the past with respect to Max House and Max Square.
Okay. So I just want to just one additional question in that. Just whatever our target we have, like around 4 to 5 million in next 5 years. So you mean to say it's a leasable developable area, or you will own that asset, you will own that leasable area? How it will work?
No. So what we mean is that will be total area under development.
Development, okay.
Now, yeah, with respect to what proportion of that we will own will again depend on specific partnerships that we will do around those specific projects. Like in case of Max Square, while we are developing 100% of Max Square, 49% is owned by New York Life. So those specifics with respect to ownership will vary depending on specific project level partnership. But this 4 to 5 million square feet that I'm talking about is what we would like. We have a line of sight, and we would like to close in coming quarters. Of course, we will continue to evaluate more opportunities as we move along, given the lead time that it takes in bringing these projects online.
Perfect. Yeah. Yes. Thanks for query, sir.
Okay. All right.
Thanks. Yeah.
Thank you. The next question is from the line of Priyanka Singh from Athiran Securities. Please go ahead.
Hello. Good afternoon, sir. I have couple of questions. The first one would be like, what would be the company's expected yearly rental income from Max Towers and Max House when fully leased?
Nitin, would you like to take that, please?
Yeah. So, Priyanka, we expect once Max Towers is fully leased, the lease income to come from our share of ownership would be in the range of 32 to 33 crore rupees per annum. And in the case of Max House Outflow, we expect the lease rental income to come in the range of 14 to 18 crore rupees, depending upon what of phase one, depending upon we would have what's the average rental we are able to realize. This is a conservative. The range can be 14 to 18 crore for Max House Outflow.
Okay. And the another question would be, was the company able to lease any area at Max House during Q2?
Yeah, I'll take that up, Priyanka. So in Q2, we have not closed any leasing transaction. As I said, the completion certificate was received in end July, August. Prior to that, there was significant lockdown, which led to pause in several discussions that we were having pre-COVID. Just to give you a perspective, pre-COVID, which is by mid-March, we were in active discussion for 45 to 50,000 square feet of max house, which is approximately 50%. Now, some of those discussions and several new discussions, now that the building is fully operational and has got occupancy certificate, is back online starting August, September. And as we speak, as I said, we are in advanced discussions with some of them. So hopefully, as we move along, we'll come back and update you on new leasing in Max.
Okay, that was helpful. Thank you.
Thank you. The next question is from the line of Jigar from Financial Risk Technologies. Please go ahead.
Yeah, thank you for taking the question. One question I had regarding the Max Estate division. So when do you expect the Delhi one closure to happen? I believe the hearings are ongoing with NCLT. They've recommenced, but when do you expect the closure to happen, sir?
Yeah, I'll take that. I think putting a definitive timeline to a court process is a little bit difficult. But as I said, the two good developments. One, basis home buyer appeal in NCLAT. NCLAT has directed NCLT for expediting the hearing and go for a time-bound closure. And second, in October, the hearing has restarted. We have our next hearing on 4th of November. So at this stage, I can only say we are hopeful over next 4 to 6 months we should get this towards closure. But yeah, you cannot be definitive about court hearings.
And what would be our investment towards this?
Yeah, Nitin, you want to take that up?
So, at this point of time, we don't have financial investments into this. What we have provided, it's a legal cost which we're incurring currently. And as far as the total deployment of the project, I think so the matter is under sub judice. Once we get the clearance from the NCLT, we would be able to provide more details about the investment.
Any ballpark figure range?
So, Jigar, we would prefer that once that we come to the closure from the court, we can give the more detailed presentation to the investors about our investment in this project. Very broadly speaking, the way we have structured it is we have tried to match both the inflow and outflow from the receipts of the project charge. More details will come later.
Okay. So my second question was regarding the packaging division. In terms of, do we export to Japan? And what would be the export proportion of our sales? And how do you see it as an opportunity?
Ramnik, will you answer that?
I think I'll take that. Sahil here. Basically, on Topan, we've started exports. Business has finally started taking off. The volume uptake is slightly slow, and obviously it takes a little bit longer with the Japanese quality and all of those approvals. So we finally secured those, and we're very hopeful in the next financial year to ramp up this business.
So they would be exporting to Japan or
to their global requirements, to Topan's global requirements.
So what kind of opportunity can we look at?
It's too early to tell, but obviously Topan is a large consumer of BOPP film, and we have now developed extremely high-end, patented, specialized products for them. So hopefully they are able to get an uptake from their customers in due course. So very difficult to put a number on volume yet, but it's expected to be obviously very significant.
And in terms of realization, what would be more profitable, the export market or domestic?
This particular business would be more attractive.
Export opportunity.
That's right, in this case.
Okay. Thank you so much and all the best.
Thank you very much.
So shall we take the next question?
Sure.
Thank you. The next question is from the line of Isha Savla from RA Securities. Please go ahead.
Hello, sir. Thanks for the opportunity. My question is, what would be your Kpix outflow in RE business in next 2 years?
Nitin, do you want to go ahead with that?
If I can answer that. In the next couple of years, we are, as per the current plan, we have got Max House Phase 2, which we are deploying going forward. And then we have got the Max Square project, which is underway. These two projects are both these projects have achieved the Max Square project has achieved the financial closure for it, and we are expecting to deploy a total number of close to 250 crores going forward on the project, including all the ancillary costs, and a cost of 60 to 65 crores to be deployed on the Max House Phase 2 of the project. In addition to that, as we mentioned, that we are also looking forward to getting the award from the NCLT for the Delhi 1 project. That would be over and above these two projects.
Okay. And so what is the plan to do with the money received from the selling stake in the Nykaa?
So in Nykaa, we have been gradually reducing the stake over a period of time. The latest round which we have got is around 37 crores on exiting 0.41% of our stake in Nykaa. That money is currently as a part of the treasury corpus of Max Ventures and would be deployed as a suitable opportunity.
Okay, sir. Thank you. That was helpful.
Thank you. Ladies and gentlemen, the last question from the line of Vikas Atri, an individual investor. Please go ahead.
Good afternoon. Thanks for the opportunity. My question is, in the investor presentation, it is also mentioned that we are open to outright purchase. So I'll really appreciate if you could shed some light on that.
Yeah, I'll take that up, Vikas. Nice to hear from you.
Thank you, sir.
What we meant is, as a part of our growth strategy, as we are exploring opportunities in NCR, particularly in Gurgaon, we are open for multiple models. And typically there are three models: joint venture with the landowner, or joint development with the landowner, or buying out the land along with IT or commercial license. So that's what we meant. And as we said, all of these models that we will do moving forward, again, it will depend on specific opportunities. This will be done along with a partnership with institutional investors of fund, moving along our stated asset light strategy. I hope that clarifies.
The line for the current participant has dropped. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Sahil Vachani for closing comments.
Thank you very much for your interest and time, and look forward to catching up with you next quarter as well. Thank you so much.
Thank you. Ladies and gentlemen, on behalf of Max Ventures and Industries Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.